Hey there, Iggy the Investing Iguana here, and today, I've got an exciting stock pick for you. In this video, I'll be diving into why Oversea-Chinese Banking Corp, or OCBC, has earned a buy rating with a target price of 17 Singapore dollars and 22 cents by UOB Kay analysts. As the 8th-ranked influential tiger by Tiger Brokers with over 370,000 reads, I'm here to share my insights on what makes OCBC a compelling investment opportunity. So, buckle up and get ready to discover why this Singapore banking giant is a stock you won't want to miss. First off, let's dive into OCBC's recent performance, which has been nothing short of impressive. In the fourth quarter of 2023, the bank managed to deliver a robust 12% year-on-year earnings growth, despite facing some headwinds in its insurance business. This is a testament to the bank's resilience and ability to navigate challenges. But what really caught my eye was the quality of these earnings. OCBC has been consistently improving its loan loss coverage, which is essentially a safety net for potential loan defaults. In fact, this marks the 8th consecutive quarter of improvement, with the coverage ratio reaching a commendable 151%. To put this into perspective, it means that for every dollar of non-performing loans, OCBC has set aside $1.51 to cover potential losses. This prudent approach not only demonstrates the bank's commitment to maintaining a strong balance sheet, but also provides a sense of security for investors. It's like having a reliable umbrella on hand, ready to shield you from any unexpected financial downpours. With such a robust loan loss coverage, OCBC is well equipped to weather any storms that may come its way, giving investors one more reason to feel confident about the bank's future prospects. Now, you might be thinking, hold on a second, Iggy. Didn't OCBC just set aside a massive 182 million Singapore dollars in general provisions? That sounds like a lot of money. And you're absolutely right. It is a significant sum. But here's the fascinating part, OCBC made this move despite the fact that their non-performing loans, or NPLs for short, have been on a steady decline. In fact, NPLs dropped by an impressive 17% when compared to the same period last year, and they even fell by 6% from the previous quarter. This might seem counterintuitive at first glance, but it actually reveals something important about OCBC's approach to risk management. You see, by setting aside these provisions even when NPLs are falling, OCBC is demonstrating a proactive and conservative stance. They're not waiting for trouble to come knocking on their door before taking action. Instead, they're building up a buffer to ensure they're prepared for any potential challenges that may lie ahead. This forward-thinking approach is a hallmark of a well-managed bank and is something that should give investors confidence. Think of it like this: imagine you're planning a long road trip. You know your car is in good condition, and you've recently had it serviced. However, instead of just hitting the road without a care, you decide to pack a spare tire, a jack, and some basic tools, just in case. That's exactly what OCBC is doing by setting aside these general provisions. They're making sure they have the necessary resources to handle any bumps in the road, even if their current loan portfolio is performing well. As an investor, this proactive risk management approach is a good sign. It demonstrates that OCBC is not only focused on short-term gains, but also has a long-term vision for maintaining the bank's financial health. By being conservative in their provisioning, they're creating a safety net that can help them navigate any economic uncertainties that may arise. So, while the 182 million Singapore dollar might seem like a large sum at first glance, it's actually a smart move that showcases OCBC's commitment to prudent financial management. One aspect that particularly stands out to me is the Common Equity Tier 1 Capital Adequacy Ratio, CET1 of OCBC Bank. At a remarkable 15.9%, it holds the highest ratio among all banks in Singapore. To understand the significance of this, it's important to know what CET1 represents. It's a key measure of a bank's financial strength and resilience. In essence, it's a ratio that compares a bank's core capital, which includes ordinary shares and retained earnings, against its risk-weighted assets. This ratio is crucial as it determines a bank's capacity to withstand financial distress. The higher the CET1 the better equipped a bank is to absorb potential losses and continue its operations without disruption. This is especially important in times of economic stress when the risk of defaults is high. Therefore, a high CET1 is a strong indicator of a bank's robustness and stability. In the case of OCBC, a CET1 CAR of 15.9% is well above the minimum requirement of 6.5% set by the Monetary Authority of Singapore for Singapore incorporated banks. This not only reflects OCBC's strong capital position, but also its prudent risk management practices. Furthermore, OCBC has consistently delivered quality earnings and demonstrated resilient asset quality, which further strengthens its financial position. So, when I look at OCBC's CET1 CAR, it certainly earns a big thumbs up from me. It's a testament to the bank's financial strength, prudent risk management, and its ability to weather economic downturns. This makes OCBC a potentially reliable and stable choice for customers and investors alike. Dividends are a portion of a company's earnings that are distributed to shareholders, and they are a key indicator of a company's financial health. They're particularly attractive to investors as they provide a steady stream of income in addition to any potential capital gains. Now, let's talk about OCBC's dividend yield. OCBC is offering an impressive 6.5% dividend yield for 2024. To put this into perspective, the dividend yield is calculated by taking the annual dividends per share and dividing it by the price per share. So, a 6.5% yield means that if you were to buy OCBC's shares, the income you would receive from dividends alone would be 6.5% of your initial investment, assuming the price of the shares and the dividend payout remain constant. This is considered quite attractive, especially when you compare it to the average dividend yield of the Singapore market, which is around 4.3%. It's also worth noting that among the three major banks in Singapore, DBS, UOB, and OCBC, OCBC has the highest dividend yield, making it a potentially lucrative option for dividend investors. Moreover, a high dividend yield can be a sign of a company's strong financial health. It shows that the company is generating enough profits to distribute a portion of it back to its shareholders and still have enough left to reinvest in its business. In the case of OCBC, the bank's strong fundamentals, such as its robust capital position and prudent risk management practices, further reinforce this. However, it's important to remember that while a high dividend yield is attractive, it's not the only factor to consider when investing. Investors should also look at other factors such as the company's earnings growth, debt levels, and future prospects. OCBC Bank, a prominent financial institution in Asia, has a comprehensive strategic plan that aims to lead the way towards a sustainable future in the region. This strategy is multidimensional and focuses on several key growth areas. Firstly, OCBC is targeting the increasing wealth in Asia. With the region's rapid economic development, there's a growing number of affluent individuals and businesses in need of sophisticated financial services. OCBC aims to cater to this rising wealth through its strong presence in Singapore and Hong Kong and its digital offerings. The bank is well positioned to capture this growth due to its deep understanding of the local markets and its wide range of wealth management products and services. Secondly, OCBC is focusing on supporting the increasing trade and investment flows between ASEAN and Greater China. The economic ties between these regions have been strengthening, and OCBC, with its strong network and expertise in both regions, is uniquely positioned to facilitate these flows. The bank's cross-border capabilities enable it to provide seamless and efficient services to businesses engaged in trade and investments between these regions. Lastly, OCBC is committed to driving the transition to a low-carbon world. Recognizing the urgent need to address climate change, the bank is taking active steps to support the shift towards a more sustainable, low-carbon economy. This includes providing green financing, promoting sustainable practices among its clients, and reducing its own carbon footprint. OCBC's commitment to sustainability is not just about doing what's right for the environment, but it's also about unlocking new opportunities in the green economy. These strategic initiatives reflect OCBC's forward-thinking approach and its commitment to creating long-term value for its stakeholders. It's exciting to see how these plans will unfold and how OCBC will continue to innovate and lead in these areas. As always, the execution of these strategies will be key, and I'm keen to see how OCBC navigates the challenges and opportunities that lie ahead. It's clear that OCBC is not just planning for the future, but is actively shaping it. One aspect of OCBC's strategy that really caught my attention was their ambitious target to generate an additional 3 billion Singapore dollars in revenue over the next 3 years. This is no small feat, and it demonstrates the bank's commitment to growth and innovation. To achieve this goal, OCBC has identified 4 key areas that they believe hold the most potential: Asian wealth, trade and investment flows, the new economy, and sustainable financing. Let's break these down one by one. Firstly, Asian wealth refers to the growing number of high-net-worth individuals in the region who are looking for sophisticated financial services. With its strong presence in key markets like Singapore and Hong Kong, OCBC is well-positioned to tap into this lucrative segment. By offering tailored wealth management solutions and leveraging its digital capabilities, the bank can attract and retain these valuable clients. Next up, trade and investment flows. As the global economy becomes increasingly interconnected, there is a growing need for banks that can facilitate cross-border transactions and support businesses in their international expansion plans. OCBC, with its extensive network and expertise in trade finance, is poised to capitalize on this trend. By helping companies navigate the complexities of international trade and investment, the bank can not only boost its own revenue but also contribute to the growth of the wider economy. The third pillar, the new economy, refers to the rapidly evolving digital landscape and the opportunities it presents. From e-commerce to fintech, the way we do business is changing, and banks need to adapt to stay relevant. OCBC has been investing heavily in digital transformation, launching innovative products and services that cater to the needs of the digital-savvy consumer. By embracing the new economy, the bank can tap into new sources of revenue and stay ahead of the curve. Finally, sustainable financing. As the world becomes more environmentally conscious, there is a growing demand for financial products and services that support sustainable development. OCBC has been a leader in this space, offering green loans and bonds, as well as financing renewable energy projects. By aligning its business with the principles of sustainability, the bank not only positions itself as a responsible corporate citizen but also opens up new avenues for growth. If OCBC can successfully execute on these 4 pillars, the potential impact could be significant. An additional 3 billion Singapore dollars in revenue would not only boost the bank's bottom line but also provide a strong foundation for future growth. It could also have a positive ripple effect on the wider economy, supporting businesses and individuals in their own growth and development. Of course, as with any strategy, there are risks involved. The global economic environment is constantly evolving, and there may be unforeseen challenges that OCBC will need to navigate. However, the bank has a few key strengths that give me confidence in its ability to weather any storms. Alright, there you have it, the reasons behind OCBC's buy rating and 17 Singapore dollars and 22 cents target price by UOB Hyan. With its strong earnings quality, high CET1 CAR, attractive dividend yield, and promising growth strategies, OCBC is a stock that deserves a closer look. As always, remember to conduct your own research and consider your risk tolerance before making any investment decisions. If you found this analysis insightful and want to stay up to date on more investment opportunities, be sure to smash that like button and subscribe to the Investing Iguana channel. I'll be back with more stock picks and financial insights to help you navigate the exciting world of investing. Leave a comment below with your thoughts on OCBC or any other stocks you'd like me to cover in future videos. Stay savvy, keep learning, and happy investing.